If you want big stocks, effectively you have two ways. Either you are value investor or you are growth investor. And actually, question is, which of these approaches are better? And actually, is this classical approach to stock picking strategies work today? Well, in this video, we'll find out exactly that. So first things first, let's start with value investing. Value investing is known by late and great Benjamin Graham, who actually created value investing as a concept, and of course it was made globally famous by its best student Warren Buffett, who is one of the richest men for decades. And effectively what that means that we are investing in strategy where we are finding companies which are worth dollars by buying that for cents. So what did Benjamin Graham did in his classical approach in the 1930s and 50s? Actually, the idea was unbelievably similar. He just looked at companies' balance sheets, he evaluated what the current worth of net assets, or in other words, what's the worth of assets minus current liabilities, and he simply used it as a company's liquidation value. And he looked whether this company's liquidation value was higher than company's market capitalization. If it was, he bought that company because he virtually had 100% chance of making money. Now, it's safe to say that these kinds of opportunities don't exist anymore, and this was possible when the markets were depressed and they were way more immature and less efficient than they are today. So what would typical value investor in today's markets do? He would draft this simple approach where he could actually evaluate that company is stable and it has good business model and low debt levels, so it wouldn't go out of business anytime soon. Then he would pick up the companies which has best value metrics, and then he could look at these companies and see how they perform against S&P 500. That's one approach. How could investor work with second approach or growth approach? Here the idea is different. The idea of growth investing, I would say, is thought up and developed in today's world by Philip Fisher, who actually was also one of the inspiration of great Warren Buffett. He has more qualitative approach, namely he looks at good businesses and then try to buy these businesses and look purely from business perspective how they perform. And I would say this approach would be really relevant if you are buying whole businesses or work in private equity. But from, I would say, classical, 60s and 70s approach, it would look like something as follows. You go to a department store or shopping mall and see that there are new chains of fast food or department stores which has very good new product. People are very interested in product, it has good quality, good customer service, and you see that business might have real chance to succeed. Then you look at this company up, check its financial statements, see how it's valued in stock market, and you have like objective guess that it might be next big thing. So if it has like 2 or 10 stores, you might have presumption that you might have next big national chain of 5,000 stores. And so you are buying in, and even price to earnings ratios are really high, even though the revenue is small and profits are inconsistent, but you are willing to take that risk because if you are investing here correctly, you are buying next Walmart. In today's world, of course, it would be very difficult to invest like that, and if we are looking for next big growth companies, that probably will be in tech space. So these would be probably AI companies, e-commerce companies, maybe, I don't know, electric cars and everything else which we had in the past 10 years. So in this case, we have to go and look at business from, I would say, more VC approach. For instance, we have great success story of Instagram, which was sold to Meta, or in those years Facebook, for $11 billion without having revenue. Why? Because it had customer base and Facebook knew how to monetize that customer base. And here then we have to see different metrics. What's the market share or specific industry? What's the growth of new customers, and what's the value of these potential customers? Even the service is free, because the way how to monetize on these customers might come handy at later phases of business. So this is the approach. You are looking probably at next Ubers, next AI companies, and something similar. So that's, in other words, might be like short conclusions to growth approach and value approach. And what's most importantly, you should always understand that you have to invest either in one direction or another. You cannot buy in next Ubers or next AI companies by judging them as value companies. It wouldn't work. So you have to have strict criteria how you could value your value companies, and equally strict criteria how you could actually value your growth companies. Yes, one might be more quantitative, other more subjective, but still you have to have understanding what you are doing. Warren Buffett famously said he don't invest in companies which he is not understanding. That's why he was out of tech stocks for decades. And this is one reasonable consideration if you are investing in new industries, whether this is crypto, blockchain, AI, electric cars, whatnot. You have to understand the business model. Then if you have to understand the business model, you have to understand how tech companies are valuated and what are the objective valuation metrics and criteria for them. If you understand this thing, then you could stack more arguments and more data to make some investing strategy in growth niche. If you don't understand it, do not invest in these companies. Investing in index funds will be better than you. So, conclusion here is simple. Either you could buy stable companies for undervalued prices to get consistent returns, or you are making investments in next potential time baggers. But always understand that you have to separate these approaches. If these are growth stocks, you have to have very strict, very tight criteria how you could actually understand and evaluate these businesses, and you have to be diversified because it's extremely risky to spend most of your capital in some relatively unknown tech stock. Same with value investing. You have to have very strong, quantifiably measurable criteria how you could actually evaluate these companies, because in most cases there are reasons why they are undervalued, because they are bad businesses. If you don't understand this approach, it's better for you to invest in index funds. But if this is for you, subscribe to my YouTube channel and watch next of my videos, because there we will analyze how actually we could have good value investing strategies and good growth investing strategies, because in both of these categories there are indeed good strategies and good criteria how you could actually pick good stocks and make decent money. So let's meet later and start work on this topic.